Hey everyone, welcome back to Paisa Pathshala. You've probably seen them, the guys on Instagram or YouTube flaunting luxury cars, claiming they turned 10,000 rupees into a lakh overnight. They call it trading secrets. But let's be honest, if it sounds too good to be true, it almost always is. Today, we are cutting through the noise and talking about what those finfluencers often get wrong about the stock market. The biggest lie you'll hear is the get-rich-quick trap. Influencers love showing you screenshots of green candles and massive daily gains. What they don't show you? The days they lost everything. Investing isn't a lottery ticket. It's a marathon. When someone tells you they have a hidden strategy to beat the market every single day, just remember, even Warren Buffett doesn't win every time. Next, let's talk about stock tips. Many influencers suggest buying a specific stock because it's about to explode. But here's the reality, if a random person on the internet knows a stock is about to jump, why are they telling you for free? Usually, it's because they've already bought it and are waiting for retail investors like us to push the price up so they can sell. That's called a pump and dump scheme. Influencers often ignore your individual risk profile. They'll tell a college student and a 50-year-old parent to invest in the exact same high-risk crypto or volatile small-cap stock. That is dangerous. Your investment strategy should depend on your age, your financial goals, and how much you can afford to lose. One size never fits all in finance. Have you heard the term diversification used loosely? Some influencers say you should own 50 different stocks to be safe. That's not diversification, that's diversification. If you don't understand what you're buying, owning 100 bad companies won't save you. You're better off understanding a few solid businesses or using a simple index fund that tracks the Nifty 50. Let's address the elephant in the room, trading versus investing. Influencers often mix these up. Trading is short-term, technical, and frankly, it's closer to gambling. Investing is holding a business for years because you believe in its growth. Most people have full-time jobs or studies. You don't have the time to watch the screen for intraday moves, and that's perfectly okay. They also love to bash mutual funds as too slow. They'll say, why earn 12% in a mutual fund when you can make 10% in a week trading options? That 12% return in a SIP or systematic investment plan is what builds wealth over a decade through the power of compounding. It's boring, yes, but it's consistent and proven. Another red flag? Promoting unregulated apps or shady brokers because they get a referral commission. When you see an influencer pushing a specific trading app that looks suspicious or offers 100x leverage, ask yourself why. Leverage is just a fancy way of saying borrowed money. If you lose a trade with leverage, you don't just lose your own money, you can end up owing the broker money. We also need to talk about survivorship bias. You only see the winners. You don't see the thousands of people who followed that influencer's advice and lost their entire savings. Social media creates a skewed reality where everyone is a genius. Don't base your life savings on someone's highlight reel. So, what should you do instead? Stop looking for the next hot stock. Start by building an emergency fund. Then, learn how to read a basic balance sheet or understand what an index fund actually does. Investing is about managing your money so it works for you, not chasing thrills. Here is your actionable takeaway for today. Before you put even 500 rupees into any investment you saw on social media, force yourself to spend 30 minutes reading about what that company actually does. If you can't explain how they make money to a friend, don't invest in them. Keep it simple, stay consistent, and focus on your long-term wealth, not the short-term hype.